Most people will never understand how money really works, and that's exactly why they stay stuck financially. In this video, you'll learn how smart investors quietly build wealth over time, without hype, without gambling, and without shortcuts. Welcome to Rich Root Wealth. Have you ever wondered why some people seem to build wealth effortlessly, while others, despite earning a good salary, find themselves stuck in a cycle of living paycheck to paycheck? The common belief is that the key to financial freedom is a bigger paycheck, a promotion, a higher-paying job. But what if I told you that for most people, income is not the answer? What if the real difference between financial struggle and financial security isn't about how much you earn, but about how you think? The truth is, wealth isn't built by income alone. It's built by strategy. It's a game of discipline, not drama. Over the next few minutes, we're going to dismantle the common myths that keep people financially trapped. We will explore the fundamental mindset shift that separates reactive participants from strategic wealth builders. This isn't about secret formulas or risky bets. It's about understanding the timeless principles that govern how money truly grows, so you can stop reacting to your finances and start directing them. Millions of people earn good money, six-figure salaries even, and yet they have little to show for it. They are trapped on a treadmill, running faster and faster just to stay in the same place. Why does this happen? The answer lies in a fundamental misunderstanding of how money flows. They see money as something to be spent, rather than a tool to be deployed. Their financial life is a series of reactions. A bill comes in, they react by paying it. A new phone is released, they react by wanting it. The market goes up, they react with excitement. The market goes down, they react with fear. This reactive mindset means they are never in control. They are passengers in their own financial journey, tossed around by external events and internal emotions. They haven't learned to distinguish between income, which is the money you earn, and wealth, which is what you keep and grow. Income is a flow, like a river. Without a plan, that river flows right through your hands and into someone else's reservoir, your landlord, the credit card company, the grocery store. Wealth is the reservoir you build for yourself, one strategic decision at a time. This is the core of the problem. Most people operate from a place of emotion. They chase trends they see on social media, hoping to catch the next big thing. They panic and sell their investments when the market takes a dip, locking in their losses. They get swept up in the euphoria when prices are soaring, buying at the peak out of a fear of missing out. This is emotional investing, and it's a guaranteed path to mediocrity, or worse. Smart investors, often referred to as smart money, do the exact opposite. Their approach isn't about having a higher IQ or access to secret information. It's about discipline over drama. They understand that the market is a pendulum that swings between fear and greed, and their job is not to swing with it, but to observe it. They have a plan, a system, and they stick to it with unwavering consistency. They think in terms of decades, not days. While others are checking their portfolios every 5 minutes, the strategic investor is reading a book, focused on their career, or spending time with family, confident that their system is working for them in the background. They stay calm during volatility because they've planned for it. They know that market downturns are not disasters, they are opportunities. They follow systems instead of emotions. This might be the most crucial point of all. A system removes the guesswork and the emotional turmoil. It could be as simple as investing a fixed amount of money every single month, regardless of what the market is doing. This difference in approach, systematic versus emotional, is the single greatest factor that separates those who struggle financially from those who quietly and methodically build life-changing wealth over time. To truly grasp the power of a long-term, systematic approach, we need to talk about the single most powerful force in finance: compounding. Albert Einstein supposedly called it the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Compounding is simply the process of your investments generating earnings, and then those earnings generating their own earnings. It's a snowball effect. Imagine you have a snowball at the top of a very long hill. At first, as you roll it, it grows slowly. It picks up a little snow, getting slightly bigger. This is like your initial investment earning a return. But as the snowball gets larger, every rotation picks up significantly more snow. Its growth accelerates. Soon it's growing so fast it seems to be expanding on its own. That is the magic of compounding. Let's look at a simple hypothetical case study. Meet Alex, who starts investing $300 a month at age 25. Assuming a hypothetical average annual return of 8%, after 10 years, Alex has invested $36,000. But their portfolio is worth over $54,000. The extra $18,000 is the return generated by their investments. Now let's fast forward. If Alex continues this for 30 years until age 55, they will have invested a total of $108,000. But their portfolio won't be worth just that. Thanks to the power of compounding, it could be worth over $450,000. The vast majority of that wealth, over $342,000, came not from their contributions, but from their money working for them. This is why a long-time horizon is an investor's greatest asset. It gives your money the time it needs for the compounding engine to truly roar to life. The person who starts late has to climb a much steeper hill. Of course, the path is never a straight line up. There will be storms. This brings us to the concept of risk. For most people, risk is a scary word. It means losing money. They see a market drop and they see loss. But smart investors define risk differently. For them, the biggest risk isn't volatility, the temporary ups and downs of the market. The biggest risk is permanent loss of capital or failing to reach your long-term goals. Think of it like this. Volatility is turbulence on an airplane. It's uncomfortable, it can be frightening, but it doesn't mean the plane is going to crash. Permanent loss of capital is the plane crashing. The goal of a smart investor is not to avoid all turbulence. That's impossible. The goal is to ensure the plane never crashes. How do they do this? Through diversification and position sizing. Diversification simply means not putting all your eggs in one basket. You spread your investments across different types of assets, like stocks, bonds, and maybe even alternatives like real estate or crypto, so that if one area performs poorly, your entire portfolio isn't dragged down with it. Position sizing is about controlling how much you invest in any single asset. Even if you're incredibly confident in an investment, you never bet the farm on it. By limiting your exposure to any one position, you limit your potential downside. This is how you stay in the game long enough for compounding to work its magic. You build a portfolio that is robust enough to weather the inevitable storms. Let's illustrate this with another brief case study. Consider two investors, Ben and Chloe. Both start with $10,000. Ben is a trend chaser. He hears about a hot tech stock and puts his entire $10,000 into it. The stock doubles in a month. He feels like a genius. His portfolio is now $20,000. But then, negative news hits, and the stock plummets 75%. His $20,000 becomes $5,000. He has suffered a permanent capital loss of 50% and has been emotionally crushed. Chloe, on the other hand, is a systematic investor. She diversifies her $10,000. She puts 60% in a broad market index fund, 30% in bonds, and allocates 10% to more speculative assets, including a small position in that same hot tech stock Ben bought. When the tech stock doubles, her portfolio doesn't double, but it does get a nice boost. Her $10,000 grows to $11,900. But when the stock crashes 75%, her world doesn't end. Because it was only a small part of her portfolio, her total portfolio only drops from $11,900 to about $11,150. She is still ahead of where she started. While Ben was wiped out and is now too scared to invest again, Chloe's system protected her. She weathered the storm and is still on track, calmly continuing to invest according to her plan. Chloe understands that the primary goal is not to find the one big winner, but to build a resilient structure that can survive the inevitable losers. This is the essence of a long-term mindset. It's a shift from offense to defense. It's not about how much money you can make, but about how much you can't afford to lose. Capital protection comes first, always, because if you lose 50% of your capital, you need a 100% return just to get back to even. Protecting your principal is the foundation upon which all future growth is built. So, how can you begin to apply this mindset? It starts with creating your own simple framework. First, automate your savings and investments. This is known as dollar cost averaging, or DCA. You invest a fixed amount of money at regular intervals, like every month. This removes emotion and timing from the equation. When prices are high, you buy fewer shares. When prices are low, you automatically buy more. Second, create a diversified allocation that matches your risk tolerance and time horizon. You don't need to be an expert to do this. Simple, low-cost index funds can provide instant diversification. Third, write down your rules. What will you do when the market drops 20%? What is your goal for this money? Having a written plan is like having a map in a storm. It keeps you from making impulsive decisions you'll later regret. The biggest reason people quit early is a mismatch of expectations. They expect to get rich quick, and when they don't, they become disillusioned. Building wealth is not a sprint. It is a marathon. It's boring, it's slow, and that's why it works. The financial industry thrives on activity, on hype, on making you feel like you need to. But often, the most powerful action you can take is to do nothing at all, to simply let your system work. The path to financial well-being is not paved with complexity and secrets. It is paved with simplicity, discipline, and patience. It's about shifting your perspective from that of a consumer to that of an owner. It's about understanding that your behavior, not your salary, will ultimately determine your financial destiny. By embracing a long-term, systematic approach, you can move from being a passenger tossed about by the waves of the market to being the captain of your own financial ship, navigating steadily toward the horizon. When people hear the term smart money, what comes to mind? For many, the phrase conjures up dramatic, almost mythical images. We think of shadowy billionaires moving markets from a penthouse office, or clandestine groups sharing secret information that the average person could never access. It's a narrative fed to us by movies and sensationalist news, a world of high-stakes gambles, insider knowledge, and a game that feels rigged from the start. This perception creates a dangerous illusion. It suggests that successful investing is about being part of an exclusive club or possessing some kind of magical foresight. It implies that without access to these secrets, the rest of us are destined to be dumb money, the uninformed herd that always buys at the top and sells at the bottom. But this entire picture, this dramatic and intimidating vision, is fundamentally wrong. It's a distraction from the truth. The reality of smart money is far less glamorous, but infinitely more powerful and accessible. It has nothing to do with secrets or conspiracies. In reality, smart money is simply disciplined money. It's a mindset, a process, and a philosophy, not a status. It's about replacing emotion with a framework and replacing guesswork with a repeatable, patient strategy. This is the first and most critical distinction to make on your investment journey. Smart money isn't about who you are, but how you operate. So if it's not a secret society, who actually represents smart money? The answer is all around us, operating quietly and consistently in the background. It's pension funds. These are organizations managing the retirement savings for millions of people: teachers, firefighters, public servants. Their primary mandate is not to chase explosive, short-term gains. It is to preserve and steadily grow capital over decades to meet their future obligations. They cannot afford to gamble. Their entire strategy is built on risk management, diversification, and a time horizon that spans generations. It's institutions. Think of university endowments, insurance companies, and large foundations. Like pension funds, their goal is capital preservation and steady, predictable growth. An endowment needs to fund scholarships and research indefinitely. An insurance company needs to be certain it can pay out claims 30 years from now. Their decisions are made by committees, governed by strict rules, and based on exhaustive research, not on a gut feeling about a trending asset. It's long-term investors. This isn't about wealth, it's about mindset. A long-term investor can be anyone, from a seasoned professional managing a fund to an individual diligently contributing to their retirement account every month. What unites them is their perspective. They see market downturns not as a crisis, but as a potential opportunity. They measure their success in years and decades, not days and weeks. They are the gardeners of the financial world, planting seeds they don't expect to harvest for a very long time. And crucially, it's people who understand cycles. These investors have studied history. They know that markets move in predictable patterns of expansion and contraction, of euphoria and despair. They recognize that no trend, whether up or down, lasts forever. Because they understand the cyclical nature of markets and human emotion, they can act with logic when others are driven by fear or greed. This leads us to the core behavioral difference. Smart money doesn't chase headlines. When a news channel is breathlessly reporting on a new, hot asset that has already skyrocketed in price, smart money is often quietly taking profits. They are not reacting to the news. They are often the source of the price action the news is reporting on, having made their move long before. Their strategy is the opposite of reactive. It positions early and waits. This requires immense patience. It's like being a skilled surfer. The amateur frantically paddles for every small wave, exhausting themselves. The expert, however, studies the ocean. They see the subtle signs of a large, powerful wave forming far out at sea. They paddle calmly into position, long before anyone else even notices the swell. And they wait. When the wave finally arrives, they are perfectly placed to ride it, making it look effortless to the untrained eye. Investing is no different. The hard work is in the analysis and the positioning. The waiting is the execution of the plan. This patient positioning is not based on hope. It's built on a foundation of deep, multidisciplinary research. Smart money operates like a team of scientists, not a room full of gamblers. They study the fundamental forces that shape our world. They study broad economic trends. Is the global economy expanding or contracting? Are major economies stimulating growth or tightening their belts? These macro currents are the tide that lifts or lowers all boats. They study interest rates and inflation. These are the gravity of the financial universe. They dictate the cost of capital, influence corporate earnings, and determine the real return on any investment. Smart money understands the central bank's language and anticipates its moves. They study technology adoption. They look for transformative shifts, like the dawn of the internet or the rise of mobile computing. They identify the fundamental infrastructure being built and invest in the underlying value, not just the short-term hype. And perhaps most importantly, they study human behavior. They understand that markets are driven by people, and people are driven by powerful emotions, fear, and greed. By understanding this psychological loop, they can detach from it, using widespread panic as a buying signal and irrational exuberance as a time to be cautious. They don't need excitement. Excitement is a liability in investing. It clouds judgment and leads to impulsive decisions. What they need is probability on their side. Every decision is a calculated assessment of risk and reward. They are not trying to be right 100% of the time. They are trying to build a portfolio where their wins are meaningful and their losses are managed. It's a game of inches, played over a lifetime. This is the essence of smart money. It's not a secret, it's a science. It's not about drama, it's about discipline. One of the biggest mistakes beginners make is thinking short-term. They ask, how much can I make this month? Smart investors ask, where will this be in 5 to 10 years? Time is the most powerful wealth-building tool. Compounding doesn't feel exciting at first, but over time, it becomes unstoppable. That's why patience beats talent in investing. Risk is not volatility. Risk is not price movement. Real risk is not understanding what you own. Overexposing yourself, using leverage without experience, making emotional decisions. Smart investors don't try to eliminate risk. They manage it. They diversify. They size positions correctly. They protect capital first. Growth comes second. Crypto wasn't created to make people rich. It was created because traditional systems failed. Bitcoin introduced scarcity, decentralization, transparency. It offered an alternative system when trust in institutions declined. That's why long-term investors view crypto as infrastructure, not lottery tickets. Bitcoin is not the same as altcoins. Bitcoin is digital scarcity. Altcoins are digital innovation. Bitcoin is treated like digital gold. Altcoins are technology experiments. Smart investors usually anchor portfolios with Bitcoin. Allocate smaller portions to select altcoins. Avoid hype-driven tokens. This balance reduces risk while maintaining upside. Every market, from ancient trade routes to modern digital exchanges, breathes. It inhales and it exhales. This rhythm is the fundamental pulse of finance, and we call it a cycle. Understanding this is not just an advantage, it is the very foundation of sustainable wealth creation. Markets move in cycles. This is one of the few reliable truths in a world of financial uncertainty. But what drives these cycles? It isn't algorithms, news headlines, or complex financial instruments, at least not primarily. The engine of market cycles is, and has always been, human psychology. It's a predictable, repeating pattern of collective emotion that swings like a pendulum between two powerful poles: fear and greed. This emotional roller coaster is the single greatest reason why most people lose money in markets, even when they pick the right assets. They master the what to buy, but fail to master the when and why. And most importantly, they fail to master themselves. Let's break down this psychological journey. It begins quietly. In the depths of a bear market, after a crash, the mood is one of despair and apathy. This is the point of maximum financial opportunity, but also maximum emotional pessimism. Prices are low, but fear is at its peak. The news is terrible, experts have gone silent, and the public has written the asset off as dead. This is where smart money begins to accumulate. Not all at once, but patiently, methodically. They are buying when confidence is at its absolute lowest. Then a flicker of hope appears. Prices stabilize and begin a slow, almost unnoticeable climb. This phase is met with disbelief. People who were burned before see it as a sucker's rally, a trap before the next leg down. But as the upward trend continues, disbelief turns into cautious optimism. The smart money continues to hold, their positions building quietly. This optimism eventually blossoms into belief, and then excitement. The media starts covering the story again. Friends start talking about their gains. The fear of the last crash is forgotten, replaced by a new, more powerful fear, the fear of missing out, or FOMO. This is when the general public starts to pile in. They see prices rising and assume the trend will continue forever. They buy when prices are high because emotions are high. The market feels invincible. This is the phase of thrill and eventually euphoria. At this peak, every shoeshine boy is giving stock tips, and every headline promises a new paradigm. This is precisely when the smart money, who bought in the despair, begins to distribute their holdings. They take profits gradually, not emotionally, selling into the strength created by the public's manic buying. Then the cycle turns. The euphoric climb falters. The first drop is often dismissed as a healthy correction, a buy-the-dip opportunity. This is the complacency and anxiety phase. But the dip keeps dipping. Anxiety turns to denial, then to fear. The same crowd that bought at the top, fueled by greed, is now gripped by panic. Their paper profits evaporate, turning into real losses. The fear of losing everything becomes overwhelming. And so, they sell. They sell when prices are low because fear is high, often capitulating near the very bottom, locking in their losses. They sell their assets directly to the same patient, smart money, that is now ready to begin accumulating again. This cycle of fear and greed repeats over and over in every market and on every time frame. It is the great transfer of wealth from the impatient to the patient. So, what does it mean to be smart money? It isn't about having a crystal ball, it's about having a plan and the discipline to execute it. Smart money operates with a strategy that is independent of their emotions. They understand that the best time to buy is when you're most afraid, and the best time to sell is when it feels like you can't possibly lose. They do the opposite of the crowd. They buy when there is blood in the streets. They hold when others doubt and panic sell. They don't try to catch the exact top or bottom, an impossible task. Instead, they scale in and scale out, managing their risk with predetermined rules. Understanding this psychological framework is like being given a map in an unfamiliar land. It doesn't tell you the future, but it shows you the terrain. It helps you recognize where you are in the emotional landscape of the market. When you feel euphoric, it's a signal to be cautious. When you feel despair, it's a signal to pay attention. By internalizing the nature of cycles, you can begin to detach your financial decisions from your fleeting emotions. You stop chasing hot trends and start looking for value. You stop reacting to the noise and start acting on your plan. This is how you transform from a participant in the market's emotional drama to an observer who can capitalize on it. Understanding cycles removes the guesswork and replaces it with a timeless strategy. This isn't just theory. It's the observable, repeating behavior that governs all speculative asset classes, from Dutch tulips in the 1600s to equities, real estate, and the digital assets of today. The technology changes, but the human heart does not. Information is everywhere. Understanding is rare. The people who win long-term learn deeply, ignore noise, focus on fundamentals. That's why educational finance content performs well. It attracts patient viewers. It keeps attention longer. It builds trust, and trust is what compounds. Here's a mindset shift that changes everything. Stop trying to get rich fast. Start trying not to lose. When you protect capital, growth follows naturally. Long-term investors plan ahead, stay consistent, avoid leverage, ignore daily price movements. They treat investing like a process, not a bet. A basic long-term approach. Diversify investments, dollar cost average. Avoid emotional decisions. Think in decades. You don't need perfection. You need consistency. That's how wealth compounds quietly. Most people give up right before compounding starts. They stop because results feel slow. They chase something new. They abandon the process. Smart investors understand that early stages feel boring. Boring is good. Boring builds wealth. Wealth isn't loud. It's built quietly while others are distracted. It rewards patience. It rewards discipline. It rewards long-term thinking. If you understand how money flows and stay consistent, time works for you. If you're serious about building real wealth, don't stop here. Watch the next video to continue learning how smart investors think long-term. Subscribe to Rich Route Wealth for real strategies, no hype, and long-term financial education. I'll see you in the next one.